Hi, I'm Jason, and this is Supply and Demand Shorts. Today we're going to be talking about real GDP. There was data released today by the Bureau of Economic Analysis showing that the GDP growth rate on a real basis, that means adjusted for inflation, rising prices, was actually negative at negative 1.4%. So we're going to go through some different data points to try to build a better, more thorough picture of what's going on in the economy, both in the United States and the rest of the world. Are we in the middle of a recession or even on the cusp of one right now? I don't think so. I do think that we are about 6 to 9 months away from that, and we're going to talk about why that is. So I'm going to share some material here and get right into it. So this is just for comparison. The growth rate in the last quarter, Q4 2021, was positive 6.9% on a real basis. And on a current dollar basis, which is unadjusted for prices, the growth rate was 6.5%. And the key thing to remember about GDP is that it is ultimately a measure of spending. So you take spending from government, investment spending, consumer spending, and the net export. You combine those two together and you get GDP. So in order to get a better idea of what's going on, we're going to look at a unit called industrial production in a minute. The other thing I wanted to point out is that real disposable personal income has actually been falling since August of 2021. You won't hear the Fed chairman say that or most of the elected people, but that's what's going on here. So to a certain extent, this was a little bit predictable, and I have been tracking real disposable income on the page. But anyway, we're going to get into some indicators here. Like I said, the first one that we're going to start out with is a quantity-based production measure called the Index of Industrial Production, which has been published by the Fed since 1917. Now, what needs to happen in industrial production if what we're seeing is being in the middle of a recession or right on the cusp of one, there either needs to be a flatlining in industrial production or there needs to be a fall, indicating that the actual quantity of stuff that is being produced is not making it to the market. This usually happens in most business cycles. When I was looking at the data, I only found one exception. But what we see here is that growth has been pretty solid for about 4 months, and so we don't see anything of concern just yet there. A drop or a wavering of industrial production usually precedes a drop in GDP by about 3, 4, 5 months, something like that. So the next thing we're going to look at is the labor market. Initial unemployment claims will precede the unemployment rate going up by about 4 to 6 weeks. And we don't see any movement away from the downtrend there. So the employment situation is still looking pretty decent in that regard. We don't see an uptick in initial claims, so nothing too crazy to worry about there. Now, financial markets they provide a little bit more advanced indicator of what's going to happen in the real economy. They're often ignored by economists. I think they do that at their peril. So the reason I'm going to point this out and what we're going to talk about here, this white line is the United States government bond, the 10-year yield, so the yield on a United States 10-year government bond, and the orange line is the 5-year government bond. And what to look for here, so an increase in this line essentially means that there is more selling pressure on this particular type of security than there is buying pressure, and if you reverse that, a fall in this line means that there is more demand pressure, more desire to hold this particular kind of security than there is desire to sell it in the market. And when we see these two lines, these two different points in what's called the term structure, when we see these lines converge, that's not a very good thing. And the reason for that is you have to follow go through a few logical steps to get here. But essentially what a positive gap means is that the returns in the future, the returns on invested capital, the returns on risk are expected to be better in the future than they are right now. And so if we reverse that, the other side of that coin is if we see these two lines bumping into each other, essentially that means that the longer term investors in this market are disagreeing with the shorter term investors in this market, which face different types of risk. The primary concern of the longer term investor being what are going to be the real returns available in the actual economy going forward in time. And so this is kind of negative sign number 1. These two lines bumping into each other is what produces what you've probably heard about in the last couple of months, which is the inversion of the yield curve. And so, like I said, that's sign number 1, why I do think that a recession is on the horizon, but is not necessarily happening right now. Next thing we're going to look at is we're going to look at the risk premium on different types of companies. So this is the spread on AAA rated corporate bonds, this white line. And what that means is it's the difference in borrowing cost between a AAA rated company or an investment grade rated company versus the United States government. And then this yellow line is the same concept. It's a risk premium, the difference in borrowing cost between a lesser credit rated company, which is often called junk. So this is the yield on junk bonds, the spread of the yield on junk bonds versus the yield on government bonds. So we're measuring essentially what we're seeing here is how much the market desires to hold risk assets of the debt of companies with a high credit rating and companies with a low credit rating. And what we see here is that usually leading up to the end of an economic growth cycle, these risk premiums start to rise. And we do see that in these numbers here. So the white line, which is the AAA corporate bond spread, so the risk premium on the AAA corporate bonds, that's been rising quite a bit and has actually risen twice as much just on a one-year basis as that of the high yield or the junk bonds. By the way, whenever you hear high yield bond and you hear junk bond, those are two ways of saying the same thing. One is essentially a euphemism for the other. So this is sign number 2, why there are definitely storm clouds on the horizon and why there is probably a recession on the horizon. If you think about it this way, the money that is not being invested in risk assets is not going into plants, equipment, factories, and people in order to produce goods. So it's literally the market telling you that there could be a drop in the production of goods approaching, which eventually filters into a drop in real GDP. And now finally, what we see here is we're going to look at these currency spreads. So so what we see here is we have the white line, which is the euro versus the dollar. We have the orange line, which is the Japanese yen versus the dollar, and the blue line, which is the Chinese renminbi versus the dollar. And as you can see here, the yen and the euro have actually been dropping for several months now, going all the way back to prior to the beginning of the year, basically in the fall, going into the winter of 2021. And the renminbi has had its own difficulties, especially in the last month. And what this means is a lot of dollar bond holders are actually located overseas. So foreign companies borrow in dollars. They borrow money from the capital market in dollars. And then when it's time to use that money to put into productive enterprise, again, plants, equipment, people, machinery, they convert those dollars into their local currency. And so what we see, if that trend starts to reverse, then we see a fall in the relative value of these different currencies worldwide. And these are not junk currencies. We're talking about the euro, the Japanese yen, and the renminbi at one point in history was a junk currency, but it's not anymore. So this is sign number 3, that production is looking like it's probably going to fall off in the rest of the world if it is not already, which inevitably will lead to a fall off in production in the United States. And so I hope that gives you a clear picture of what's going on in the U.S. and abroad with economic conditions. And I will obviously, as I do on my Instagram page and on YouTube, which is where this video is destined for, I will be continuing to monitor all these different indicators and more to give you an up-to-date picture on what's going on. So I hope you've enjoyed this video, and if you did like it and find it informative, pass it on to your friends if you have any, relatives if you have any, and yeah, like and subscribe, Supply and Demand Observer on Instagram, and hope you're having a good Thursday. It's my favorite day of the week, and take care. I'll catch you next time. All right.